Market is maybe not leading the Fed, maybe bullying the Fed, maybe trying to scare the Fed that if you don't do this, things could turn south. What do you think the Fed is going to do on Wednesday?
I don't think the Fed does anything on Wednesday. Look at the last eight quarters. No cut. Last 8 quarters, we've averaged 3% GDP growth, and we've had 3 quarters that were low 2% growth quarters. We're in a growth slowdown. Is it permanent or temporary? I'm in the temporary camp, and the Fed shouldn't jump to reassure the market here. They've done enough so far. They don't need to cut on Wednesday.
Andrew, do they cut on Wednesday?
Well, look, I doubt it, but it's all how they indicate. But I think that if it was a bigger concern, you wouldn't have the market within 2% of an all-time high. I mean, there's a lot of negatives, and yet the market is very resilient. I don't think this is just the story of, well, the market thinks the Fed's going to cut rates. I think there's a much deeper story of why the market is so resilient.
Which is what?
Well, what no one, look, I think we're going to have a retest of the low we had in May this summer. So first of all, I'd say that. But what no one seems to discuss is the market is at the same level it was in January of 2018. We have gone nowhere for 17 months. And when that happens, the level of bearishness builds. And eventually what happens, it's like a beach ball holding underwater. Eventually that beach ball is going to pop out of the water. We've been going nowhere for a long time. And I think that's the story of why the market is so resilient, is that so many people have grown very bearish, even though the market's hanging in there. So I don't think it's just about the Fed. I think it's about positioning is very, very negative right now.
Heck, look at the valuation of the market. It's only 17 times. The 10-year Treasury is 2.1%. Equities are a heck of a good option right here, and I think that's being reflected.
Although you could
in the
make
market.
the argument, Jim, that 17 times is not cheap based on historical measurements.
I think
Brian,
relative to the interest rate environment, it's very cheap.
Would you commit your money, Brian, for a 10-year at 2.1% for 10 years? Would you lock it up for 10 years that way? I don't think so.
If I felt that the equity market was going to fall 10 or 20% in the next 2 years, I would.
But if you're there for 10 years, the next 8 are probably going to be pretty darn good, and you get a 2% dividend yield while you're waiting.
Yeah. I just think that Andrew has a good story, but he's missing 1 or 2 chapters, which is that the market has kind of tread water here amid a huge downdraft in yields and a major expectation for the Federal Reserve to cut rates. And you could argue, and I think there's some sort of analogous beach ball metaphor here, which is more along the lines of the Fed rate cuts are the buoys that are holding the market up, at least from falling further. And that, I mean, he may be right that there's something else going on relative to why the market remains close to the highs, but it would be very interesting to see the Fed chairman repeat the words patient and otherwise convince the market there's no rate cut and see what happens to the level of equity.
But Andrew,
look, I just want to make sure it's understood. Look, the market's up 16%. It's June. I wouldn't get aggressive here on the market going into the summer. I mean, that's a big return already. I just think eventually this thing, I think we're going to have a retest, maybe 2,700 or 2,750. But I think the longer this thing goes without breaking the upside, the more it's likely to break to the upside.